Hello there. Today we're going to solve an IGCSE accounting paper 1 to May June 2021. Let's begin. Before we start, I remind you to hit the subscribe button, maybe turn on notifications because more papers will be uploaded. Hopefully, I'm trying to upload them, all the latest papers before the exams start. The May June session is just around the corner, 2022. So my goal is to upload all of them by tomorrow. So, all right, let's start. Number one, which statements about bookkeeping and accounting are correct? This is a repeated question. I saw this in the other variant as well. And this is repeated. So, accounting, you need to know the definitions of both. Bookkeeping is the detailed recording of the daily transactions, and accounting uses those records to prepare financial statements and make decisions. Accounting is performed periodically rather than daily. Yes, monthly, half yearly. Accounting relies on having accurate bookkeeping records. It does. Bookkeeping includes the preparation of financial statements. No, it doesn't. It only records the details. This is job of an accountant. Bookkeeping involves the recording of financial transactions. Exactly, yes, that's the job of a bookkeeper. 1, 2, and 4 is the answer A. Let's move on. What increases owner's capital? It looks like this is also a repeated question from the other variant 1.1. So it's a better idea to watch all the videos actually from 2020 and 2021 because you will see some there'll be some overlap, and watching all of them will benefit you the most. Um, what increases owner's capital? Bank loan extended from 5 to 10 years, that's a liability. Purchase of inventory on credit, that is nothing to do with capital, that's just purchasing an asset and creating a liability. Purchasing an asset, and one asset goes down, the bank goes down. Transfer of vehicle to business from private use, that is called capital introduced, which is actually the answer. That's going to increase the capital. William paid 500 in cash to Sonia for rent. How did Sonia record this? Okay. So for Sonia, that's some money coming in for Sonia. For her, cash should be debit for sure. And actually, that is the only option we have, right? Because she's getting cash, and cash should be debit in that case. It's such a beautiful, straightforward question. You get a free mark for that. Number 4. Abdul buys all his machinery on credit. He provided the following information. Okay, he buys everything on credit. Maybe that's gonna be relevant later. Machinery at cost. Okay, so it seems like during the year more was purchased. Okay, amount owing to suppliers for. Okay, he buys all his machine on credit. Looks like we bought 12,000 worth of machine during there, unless there was any disposal. During the year, Abdul paid 25,000 to the suppliers of his machinery. Okay, so in the beginning he owes 19,000, right? And then he purchased 12,000 worth of machine. So now he owes 12,000 more. What does he owe in total at the end of the year? He owes 19 plus 12, 31,000, right? 31,000 is what Abdul owes. And he paid 25,000 already, so he doesn't owe that anymore. 25,000 will be subtracted. And I think we can all see the answer, which is A. Let's move on. Number 5. Shula and Yasmin. I remember these names. I think these appeared in the previous paper as well. Shula's financial year ends on 31st March. On 1st April 2021, there was a credit balance of 100 on Yasmin's account in Shula's purchase ledger. Always clarify the relationship. Shula is the customer, Yasmin the supplier. So in a normal case, customer owes supplier, right? Customer has to pay supplier. Yasmin had. Why would Yasmin pay as a supplier? Yasmin. Why would Yasmin owe? Uh, well, the balance is 100 from Shula's perspective. It shows that it's a liability of $100 for Shula, and that's it. Okay. Payment is not represented with the balance. Okay. Payment does not mean balance. Number 6. Hasina buys radios from Nazneen. Again, a repeated question from the previous paper, not the previous year though. They won't repeat so many questions from one session to another. There might be a repeated question from one session to another, but not like that. Not 5 of those, right? Anyway, Hasina buys radios from Nazneen at a list price of $10 each. 12 radios were purchased. So during the purchase, at the time of purchase, 20% will be deducted, and at the time of returning, also 20% will be deducted from the list price. So if two radios were returned, well, what's the list price of those two radios? It's $20. However, the credit note issued, or the return that actually went through, or the refund, if there was any, would be how much? Well, remove 20%. It's going to be $4 less, right? It's going to be 20 minus 4. $16 will actually be the return amount, because we never purchased it on $10 each. We purchased it on $10 minus 20% when we purchased. So while returning as well, we have to remove the 20%. That is the rule. Jamil sold goods on credit. Where did he first record the invoice he issued? He issued the invoice, so it's a sales for him, and sold on credit, right? So that goes into sales journal. The whole purpose of sales journal is to record credit sales, and we're going to use it for that. Number 8, which statements about 3-column cash book are correct? It contains ledger accounts for bank and cash. It does. Yes. It contains ledger accounts for discount. Okay, you may think it is the answer, but no, they are just there for reference. That's not the actual ledger account of discount allowed and discount received. If you notice, we never balance those columns, right? We only total them and then we transfer them to the ledgers, to their specific ledgers. So remember, discount allowed and discount received are prepared separately. In the cash book, they just appear for convenience, right? So we collect all them together, we total them, and then we transfer to the actual ledger accounts of the discount accounts. Uh, it records transactions before they are recorded in ledgers. Because it's a book of prime entry, I believe, yes, that should be the right answer. Because it is a book of prime entry, right? If there's a cash transaction, it first goes into cash book and then the other places. Which statement is not true about a trial balance? It is a list of ledger account balances at a certain date. That's a good definition of trial balance, so that's not true. That's actually true. It can assist in finding arithmetical. Yes, it does. Like, that's true. It's part of double entry system. No, it's not. So this one is the option. This is not true. It is useful in preparing finance. Yeah, all these options are true. Even if you know the true options, you can cancel them. You would know that C is the only answer. Now remember, trial balance is not part of double entry system. What does that mean? It means the items that appear in trial balance are not as a result of a double entry. They just appear, they're just a list. They literally mention that here. They're a list of ledger. When something is a list, it cannot be really a double entry, right? Double entry is not given in terms of as a list. It's given as a debit and a credit. I hope that makes sense. I just want to remind you, what else is not part of double entry? Trial balance is not part of double entry. Your statement of financial position is not part of double entry. Your let's say the sales purchase journals are not part of double entry. They're just a list, right? So there are these few things which are not part of double entry. Remember that income statement is part of double entry system. Let's move on. Which error is an error of original entry? So when you enter a wrong amount to your accounts. Sale of surplus office equipment on credit to Janet for 230 entered as 320 in both the disposal and Janet account. That looks good to me because we messed up in on both the sides, and the whole amount is wrong. So it looks correct, but we'll see the other options as well. Sale of surplus office equipment on credit to Janet for 230 entered in the office equipment account and Jason's account. Well, there's nothing wrong with the amount entered. Original entry is about the amount. So again, I think the problem here is that none of them talk about amount being different, right? From what I can see. So this is the only one talking about amount being wrong, and the double entry got messed up with that wrong amount. So yeah, this is the only option. Let's move on. A check $85 received from Shakil was credited to the account of Shams. Which journal entry corrects this error? Look, Shams had nothing to do with it. Why did we credit the account? Shouldn't have been done, right? So we debit Shams, that's for sure. We know that Shams will be debited, and Shakil, the one who was supposed to be credited, will be credited. Okay, so the problem was with the Shakil and Shams. Nothing was wrong with the bank. Why would you credit the bank, right? Bank had nothing to do with it. And also, you receive the money. Why would you credit your bank? You see, this option also does not make sense, because even if you have a confusion, you would say A would be the answer, but then also that doesn't make sense because we have to debit Shams. So all in all, it's just by canceling you can find a lot of answers really. Number 12. Jamal's bank statement on 1st May 2021 showed a bank overdraft of 1460. Essentially, it's a negative balance. At that date, there was unpresented checks of 385 and uncredited deposits of 255. What was the cash book balance? So we just have to reconcile that. The bank statement shows 1460. We start with that, negative 1460. You must understand the meaning of these terms. Unpresented checks are the payments you have made, but they're not presented to the bank yet. So you, let's say, gave a check to someone, you made a payment to someone through a check, and the check is still with them. They haven't presented that to the bank yet. So it's not yet deducted, right? It will be deducted eventually. So we have to remove it. 385, remove that. It will be eventually gone, that's why. And uncredited deposits. Deposits are money you put into bank, money that goes into your bank. And they're uncredited means they're still in the process. They're supposed to be added to your account, but they're still not added because they're still in the process. So we add that, right? We just reconciled our bank um, statement. Please make sure when you enter this 1460 in your calculator, don't forget to put a negative with it because it's an overdraft. So negative 1460 minus 385 plus 255. That's 1590. Negative 1590. And negative 1590 means in a cash book that is represented with a credit balance. Okay, a credit balance means a negative balance in a cash book. It's the opposite in a bank statement. A bank statement has a bank overdraft here, and that would be represented with a debit balance. Okay, you should know that. What is included in purchase ledger control account, also known as total trade payables account? If you think about it this way, it might help you. What is included? So cash purchases, no, they will not affect your payables, will they? They won't. Debts written off as irrecoverable, you can only write off debts when they're receivable. Like if you are gonna pay someone, you cannot just write it off as bad debt or an irrecoverable debt. It has to do with sales ledger control account or total trade receivables, not with total trade payables. Discount allowed is also with the receivables. When you're receiving money, you may allow some discount. There we go. We've cancelled the wrong options. We only have, I didn't even read it yet. But if we read it, we realize goods returned to credit suppliers. Well, it has to do with credit suppliers, so payables, right? Our payables will fall when we return goods. In your PLCA, this is a credit entry. Easy question, really. Jaweed, number 14. Javeed's sales ledger control account had a debit balance of 12,000. I think I recognize this one as well from the previous one. So we make a T account, 12,000. Interest on overdue account, $40. And discount allowed was omitted. Okay. So had been omitted. So what will be the actual balance? Well, we don't even have to make this T account. It's so straightforward. So we have some receivables. These are our receivables, 12,000. And then we are charging some interest to those who haven't paid. And so we're going to receive this as well. We're going to receive this. We're going to receive these. These two are our receivables. There's a balance, like this is receivable since the last period. And this is the new receivable of interest. And when you allow discount, that reduces your receivables. You're not going to receive that amount anymore. And so you subtract that 150. So 12,000 plus 40 minus 150, 11,890. 11,890. And that, of course, is option B. I also want you to see the T account method. So 12,000 is the balance brought down. And well, this increases our receivables, the interest. So we, interest. So we put it on the debit side because it increases our receivables, total trade receivables. That's what it is. Sales ledger control account is total trade receivables. And discount allowed reduces that. And so it reduces the asset. So we credit the asset account, discount allowed. Now when you balance this, you will get the new balance. You'll get that the new balance is 11,890. That will be the carried down balance. Okay, let's move on. Which statements about capital expenditure are correct? It is money spent on day-to-day business operations. That's the opposite. That's the revenue expenditure. Revenue expenditure. That's the definition of revenue expenditure. It is money spent on purchasing non-current asset. Well, yes, it is part of the answer. Yes, it is recorded in statement of funds. That's also true. I think I explained that in the previous video, how capital expenditure goes into SOFP, and revenue expenditure goes into income statement as a regular expense. It includes expenses relating to non-current assets. Well, you see, the thing is, we already have the answer. This is the only possible option available to us because we don't have any options which has a 4 in it, right? So that's definitely wrong. If you know that these two are right, this is definitely wrong because we only have options like these, two maximum, right? So that should be correct. Nia sold, and actually, wait, by the way, let me clarify. It includes in expenses relating to non-current assets? Wrong. It includes, what if you're maintaining it? Okay, so some of you might think this is true because in your mind, what's going on is the expenses relating to the purchase of non-current asset. Now that's different. Okay, expenses related to purchase of that asset, like delivery and carriage, well, that will be part of capital expenditure, but not general expenses relating, like, let's say, maintenance or repairs or even petrol for a car. See, that's what they're talking about here. So that's not true. That's not part of capital expenditure. Let's move on. Number 16, Nia sold equipment with a net book value of 200. The proceeds of sales were 250. Okay. So it seems like she made a profit because her net book value was 200 and she got 50 more for that. Were credited to the sales account and debited to the cash book. That's the mistake. You're not supposed to credit that to the sales account because you didn't make a sale of that. The only effect of that on your income statement would be a $50 profit, right? So our gross profit is overstated by the whole 250, by the full 250, because we included this in our sales, which never existed. These sales never existed, and just knowing just knowing that, you know that gross profit was overstated, so this is also wrong, and that is it. Profit for the year was overstated by 200 only because $50 was our income anyway, right? So we enter 250 as a sale, which never existed, so gross profit is overstated. Then after gross profit, we're gonna add this 50. Like, we remove the 250 because that never existed, but we also add the 50 as an income. So overall mistake or overall problem here is, overall effect on the profit is only 200. Please investigate this further, try to understand this because it looks a bit tricky for some students. Number 17, why does a business provide for depreciation on non-current asset? Repeated type of question. Understand the concept, please. It is mainly to apply the matching principle. To charge the cost of non-current asset against profit in the year of purchase, that's completely opposite of why we do it. We don't charge it in the year of purchase. We separate. We divide the cost through its useful life. To ensure that non-current assets appear at net book value in the statement of financial at a book value. So that is a bit problematic because they would normally say at the net book value, not at the book value. So it's close to being right, but there's a better option next to it. To ensure that the matching principle is applied when preparing financial statements, and that is the best option available. That is like the best option available. Option B is, I would say, like, it would be my second choice if I didn't have this C, to choose, because it's very close to the right answer. It's almost that it is correct. So if there was no better option, you can go for B, but C in this case is like precisely, it's like definitely correct. You know what I mean? Okay, let's move on. Number 18. A machine with an original cost of 10,000 had been depreciated for 2 years at the rate of 10% per annum using straight lines, so $1,000 a year. In total, in the 2 years, it's depreciated by 2,000, right? Do you all agree with me? 10% of 10,000 is 1,000, right? It was then sold for cash with the loss on disposal amounting to 700. Okay. A replacement machine was bought on the same day for 12,400 cash. What was the net decrease in the cash balance? The net decrease. There's a small problem with this question that I don't fully understand. Are they talking about the net decrease for all of these transactions, including the purchase of that? Or actually, no. Yeah, you see, that is a bit problematic as a question. Well, let's try. So we'll assume that we're taking this 10,000 as well, right? The machine with an original a machine with an original cost of 10,000. So what is the net book value of that machine? 10,000 minus 2,000, 8,000, right? That's the value of machine, and we sold it for a 700 loss. What does that mean? That means how much money you think we got for it? Well, we got 700 less than what we thought it was. So we got 7,300 for that machine. That's what came in to us. Okay? And well, okay, so that's money coming in. Okay, so first of all, okay, so let me just write that all together. 7,300 is what came in. 12,400 is what went out. Let's see where we go from that. Do we have an option which checks that, like which which is the net of this? We do have 5,100 as an option. So yeah, that should be right, 5,100. But I would say there's a small problem. Actually, you know what? You know what? That's a positive. Now, even if this was part of the question, you further subtract 10,000, you get negative 1,500. Now, that's not an option. So this is the only option available. Let's go for it. But I would say that they could have made the question a bit more clear, because if they gave dates, let's say if they gave us dates, and they asked us about how the cash changed, or what is the net decrease in cash balance during that particular year, and the year of disposal, let's say, right? Because we don't know if this 10,000 is also part of our calculation or not. Okay. All right, let's move on. Number 19. Why would a bakery business not include a value of inventory of his stationery in a statement of financial position? Why would a bakery business not include a value of inventory of stationery in the statement of financial position? Let's see. It was expected it would be used in the next few months. It was purchased regularly and paid for in cash. It was not for resale. It was of very low value. Now that is right. Because if something's not for resale, even then we might record it. That's not a reason to not record something. Because a lot of things in business are not for sale, but still we record them. So that's not a good reason to not include it. It was purchased regularly. That has nothing to do with not including it. It was expected to be used in the next few. Again, that is a bit off. It's a bit odd for an option. It's not really linking directly with not including that as a value, not including that as an inventory. Sorry. It was very low value. That is the materiality principle. Materiality principle, if you remember that. When something is of very, very low value, you don't record it because it's going to be more expensive to maintain that as an accounting, maintain the account of it rather than just not recording it at all. Shilpa's financial year ends on 30th April and 31st March 2021. She wrote off a bad debt. She wrote off a debt owed by Tahir as irrecoverable. Okay. Which entry did Shilpa make on 31st March 2020? Okay, so the year ends on 30th April and she made this. Okay, so what are we going to do? This question is a bit tricky, guys. Be a little careful, okay? So we are still not in the year end, right? So we don't really have to transfer this to income statement. So income statement would have nothing to do with it. What you will do is you'll just credit Tahir account because we're not going to receive that anymore. Our receivables go down. When assets go down, we credit the asset account. And irrecoverable debts and expense goes up, which will be debit because it's an expense. That's it. Let's move on. 21. How should inventory be valued? A repeated question. We did it in the last class. In the last video. So yeah, this is the option by definition. That's how you should always value inventory: lower of cost and NRV. James, an accountant. James is an accountant and operates as a sole trader. Which items would not appear in his financial statement of financial position? Long-term loan will appear. Retained earnings will not appear because he's a sole trader. Trade payables will appear. Why not? 1 and 3. Done with. Oh wait. It says which items would not appear in his statement of financial position. Sorry. Oh, wait, sorry. Which items would not appear in his statement of financial? So long-term loan would appear, retained earnings would not appear, and trade payables. Oh, it's trade payables. So he's an accountant, a service business. Service businesses do not have trade payables because they're not trading. You get it? It's not a trading business. So these two will not appear in James financial statement. 2 and 3 is the right answer. Apologies for that. You see how they can trick you with that? So there were two tricks here. This is a service business, so they will not have trade payables, and the items that do not appear in the statement. So notice this not. They even make it bold so you don't miss it. Just be a bit careful with the questions, please. You can easily make a mistake there. Zaha is a consultant who receives fees from clients. How would Zaha calculate his profit for the year? Okay, fees received minus cost of sales. Fees received minus cost of sales plus expenses. Oh, not at all. Fees received minus expenses. That looks like the best option because for a consultant, see, they're asking you a second question that has to do with service business. So it's the second question about service business. Well, in service business, we do not have cost of sales. We just have income and expenses because we are not trading goods. We don't have any purchases and opening inventories, closing inventories. 24. What is added to the owner's capital to calculate capital employed? This was also explained in the previous video very nicely in paper 1-1, May-June 2021. So I would advise you to go to that and watch this again because it's an important thing, how to calculate capital employed. To the owner's capital, we just add non-current liability. That's one of the ways to calculate capital employed. There's another way, which both of the ways come from the accounting equation. As I said, this is explained in the previous video. I advise you to go and check that out if you want to. What is an advantage of forming a partnership? Decisions have to be recognized. That's a disadvantage. It takes time and all. Each partner is responsible for actions of the other partners. Again, a disadvantage. Profits have, again, a disadvantage. Responsibilities can be shared. This is such a beautiful question because everybody can answer this. You don't even need to study accounting for that. Anne and Ben are in partnership, sharing profits and losses equally. They provide the following information. That's profit for the year. Remember, before dividing the profit, you have to adjust the profit, right? You, let's say, give salary to one partner out of the profit. Profit is made and now you distribute it first directly, and then the residual profit will be divided. What was Ben's share of residual profit? Let's see. So we have some profit. We give interest on capital directly to Anne, directly to Ben. This money goes to Anne, this money goes to Ben before being distributed, right? We do not subtract drawings. We subtract only interest on drawings. So you need to know the format of appropriation account. This is part of appropriation account. 20,000 minus 5,000 minus 4,000, and that's 11,000. That's the total distributable profit, right? That profit can be distributed between the two partners because out of the 20,000, Anne took this directly, Ben took this directly, and then the remaining money will be divided in the ratio, which is equal. So divide that by 2, 5,500. Option A. Let's move on. Which statement about receipts and payments account is incorrect? Look, guys, just be a bit careful with this little trick they're doing now. So they're including the negative within the question. You know what I mean? It includes amount prepaid at the end of the year. Not necessarily. I don't think. Well, actually, yeah, I don't think that's true, and that should be the answer. Let's see if there's any better option available. It shows the surplus. Well, that is also incorrect. That's more incorrect to me. Non-monetary items are excluded. That is true. Only monetary items are included in receipts and payments. Balance represents cash and bank balance. That's true. That's true. It shows surplus. That is done. The surplus is shown in income and expenditure account. It includes amount prepaid at the end of the year. Oh, okay. I first didn't get what they exactly meant by that. It includes amount prepaid. So, your income and expenditure account does not include any prepaid amounts, but your receipts and payment does. So if something's prepaid which belongs to the next year but you have paid it now, it will be included. That is true for receipts and because receipts and payments includes what was paid and what was received. That's all. It doesn't care about something being prepaid or accrued. What is received will be recorded. What is paid will be recorded. That's all, right? The actual movement of money. So yeah, all the monetary transactions or everything, any change in cash or bank basically. So 27B. Let's move on. How does a manufacturer calculate prime cost? That is everything direct. Direct material, direct labor, direct expenses. This should be correct. The next one is just the whole, cost of production. Of course, after adjusting the the work in progress. 28B. Some of them are so easy you don't even have to think about it so much. Nuala provided the following information. Again, I recognize this question from the last one. You should know that net assets are same as capital. Again, I advise you to go back to that paper. Look, you must watch that other video, okay? Because some of these questions were better explained in that one. That is also capital. Net assets mean the same thing as capital. Okay, so the magic formula, the so-called magic formula, I just call it that, although it's not officially called that. So we start with opening capital, 60,500, plus profit or loss, we don't know, minus drawings, because, profit includes, if this is x is negative, it's a loss. If x is positive, it's a profit. Drawings reduce the capital, so we subtract drawings, and then we get to the closing capital, which is 72 to 75. X equals, okay, 72 to 75 plus 3,900 minus 60,500 gives us 15,675. 15,675. It's a positive answer for me, so 15,675 is our profit. Let's move on. Number 30. A trader provided the following information. What was the margin? What was the profit margin? Profit margin is profit for the year in this case as a percentage of sales, while we just have cost of sales. So we'll make a little income statement with all the headings: sales, revenue, right? Cost of sales, gross profit, expenses, and profit. So if you're not totally getting something, just start doing it. You'll probably end up with the right answer. I mean, at least do that. Don't just sit and waste your time. So profit for the year is 16,000. Fill in the blanks. Expenses 4,000. Well, if we add it backwards, it's going to be 20,000, right? And we know the cost of sale is 80,000. And that is subtracted. So again, we go back from gross profit, we add it back, it's going to become 20 plus 80, 100,000. And that tells us it's 16%, because profit 16,000 over sales revenue 100,000. That's 16%. Let's move on. Question number 30 done. We're at 31. I think we're going pretty fast, if I'm not wrong. I'm not sure about the time, but feels like we're going fast. Again, a repeated question, please. As I said, go back to the video and watch it. I think I remember the answer is 9.2, but I'm not sure. So how do you find inventory turnover? You do cost of sales over average inventory In this case, the cost of sales will be opening inventory of 100 plus purchases of 2600 minus closing inventory of not 300 but actually 400, because that is a mistake. The actual one is 400. So it was found that closing. So we have to take 400 in our calculations. 100 plus 2600 minus 400 gives us cost of sale of 2300 over average inventory of what? Opening is 100, closing is 400, that's 250 average inventory. Yes, I remember it right, it's 9.2. 9.2 is the answer. Again, it's from paper 1-1 of the same session. I would advise you to watch that video. Sally's business has reached the overdraft limit set by the bank 1500 and is not able to pay its debts when they fall due. Sally is considering the following proposals. Okay. So it seems like she does not have money. The overdraft limit is reached. Okay. Which proposal will improve the working capital of the business? So working capital would improve if you somehow increase your current assets without affecting your current liabilities, right? Like that's one way to put it. There are other ways to think about it as well. Asking the bank to increase the bank overdraft limit, well, you know what's going to happen? Your current liabilities will go up, your current assets will also go up if you take out cash from the overdraft. But it is not going to improve your working capital. No improvement in working capital, so no. Borrowing 2000 from relative and paying the money back in 6 months, that is going to increase your current asset, your current liability. No, working capital will not be improved, because working capital is current assets minus current liabilities. As I said at first, do something that would increase your current assets more than your current liabilities. Obtaining a loan from bank 2000 repayable in 2 years, yes. When you get a long-term loan, that will help you increase the current assets without affecting current liabilities. Although non-current liabilities are affected, but still it helps you with the working capital. Paying 2000 from Sally's personal bank account into the business, and yes, that is also not going to increase your current liability, but it will increase your current assets. So that is correct. D is the right answer. Let's move on. 33. Company X and Company Y provided the following information. Okay, Company X has a gross margin of 36.7 and Company Y has a gross margin of 42.6, while they have the same profit margin. So although Company Y was better with the gross margin, at the end profit margin is same for the both. So Company X probably managed its expenses better than Company Y. Both companies earned the same amount of profit for the year. We cannot say that from the data. That's completely false. Company X had a better gross margin than Company Y. That's opposite of what's true. Company Y had a larger portion of expenses than Company X. This could be right. This could be right. The cost of sales of Company X was lower than the cost of sale of Company Y. If that were the case, the gross profit for that Company X would be higher, not lower than Company Y. So that does not make sense. It's opposite of what's shown to us. C is the only option, even if you cancel the wrong ones. 34. The current ratio is of X is 2:1. The current ratio of Y is 1.3:1. What does the comparison of these two ratios? Again, a repeated question. Okay, let's solve this. X has fewer liabilities than Y. That's not why the current ratio of X is better. We do not know that. We need numbers for that. We need dollars amounts for that to conclude that. Because this is just a ratio. We don't know the amounts. What if company X has $20 of current assets and $10 of current liabilities? Well, you see, their liabilities are pretty low. But what if company Y is $2.6 of current assets and $2 of current liabilities? See, although in terms of ratio this is lower, and also in terms of numbers this is lower. Well, I'll give you a better example. Sorry, what if that is 130 and that is 100? Like that is the same ratio, right? 130 is to 100 is 1.3 is to 1. So in terms of ratio this is lower, but you see the amounts of this one is higher. Are you guys getting me? Hope that's clear. So we cannot say that X has fewer liabilities than Y just by looking at the ratio. That's the point. Yeah, that's the whole idea. We cannot talk in absolute numbers when we have the ratio or percentage. X has more liquidity than Y. This seems true to me because X has a better liquidity. We can see that for every $2 of or every $1 of current liability, we have $2 of current asset to settle those. While company Y only has $1.3 of current assets for every $1 of current liability. Y has fewer current assets. Again, we cannot say that. Okay, we cannot say that with ratios. We need amounts for that. Y has more inventory than X. Not relevant. Okay, cannot say that from the data. If we were talking about, let's say, quick ratio, it might have something to do with inventory, but not in this case. Which international accounting objectives are described by the following statements? Information in financial statements must be free from material error and bias. That is reliability. Again, this is a repeated question. Or B or C, actually. Wait. I thought B is the only option, but no. B and C are possible options. Users must be able to identify differences and similarities. That's for comparison. So B is the answer. Now, again, this is also a repeated question. One last time, I want to remind you to go back to the previous video, paper 1, May, June 2021. That will be pretty useful because I think like 30 to 40% of these questions were repeated from there, and they were better explained in the previous video, right? I didn't explain it as good because it's repeated. It'll be, multiple. It'll be duplicate effort, you know what I mean? So anyway, we're done with the video. If you enjoyed the video, please hit the subscribe button, like, and share it with your friends. Have a nice day. Goodbye, everybody.